welcome to the BullCast Podcast. I'm Katie Pickler, and with me today is Cameron Spann.
Hello.
And Cortland Winsett.
Hello.
I'll call you Court one day.
Mm-hmm.
If you listened last week, then we are doing a Bull series. This is part 2. You don't necessarily need to go back and listen to part 1, but it obviously would help kind of paint the picture. Last episode, we talked about very, very, very high level, the stock market.
Yeah.
It was a history lesson, very fun and foundational.
Yeah, because there's a lot that goes into it. And that's what we even admitted early on when we did this podcast. Like, we would get so detailed on things, and we would try and pack so much into such a short period of time. The stock market is so much more than just the physical location. It is a whole way of life for a lot of people. And a lot of people sit there and go, I don't do the stock market, or I'm in the stock market. It's like, okay, what does that mean?
Yeah.
The people who say like, oh, I'm not in the stock market. Well, do you have a 401k? Is it invested? Those little acorn accounts? Like, you know, what do you got going on here? You're in the stock market.
Other things like, for instance, life insurance companies are often, the money that is paid to them, they're investing so that they can pay out to the people who they ultimately have to pay out to. You know, they don't just take in sufficient money with premiums to be able to pay everyone who dies the amount of money that they owe people when they pass away. So everything we touch, as we've said many, many times, there are any number of things that you might do in your everyday life, or that you might do once a month, or at least once a year, that is at least touched by the stock market.
Mm-hmm. And what we learned in part 1, if we're just boiling it down, is where buyers and sellers meet foundationally. Mm-hmm. We talked a little bit about New York Stock Exchange, NASDAQ, barely touched on it, but we just wanted a very historical flow so that everybody can go into part 2 ready to learn more.
Started in Amsterdam, then we moved to a tree, then moved to an iconic building, then, you know, Wall Street as we know it today. So this one, we're going to kind of dive a little deeper. We're going to specifically talk about stock market indexes, because you may have heard that. And again, there's so much jargon in our industry, which really, we've now created jargon in every industry. But what we're going to do here is talk about index, because I'm sure you've heard S&P 500, the Dow.
When I was a kid, every night on the news when I was a kid, they always talked about Dow Jones Industrial Average and where it closed for the day. That was like every day on the news, one of the headlines. Now, this was way back before they had a channel like CNBC or some of the other Bloomberg or some of the other channels that actually focus on financial news basically all day long. So really, you were only getting your news from
one source.
Yeah, ABC, NBC, CBS, those networks, they tried to cover a little bit of everything. One of the big things when I was a kid was the stock market and what's it doing? How's it doing? When did it set a new record? So we heard about the Dow and the S&P every day. They would tell us where it closed every single day.
When I think of an index, a stock market index, I just think of a bar chart that looks like the Velocicoaster. So I'm excited to talk about this in today's episode.
I would like to just side note that the Velociraptor coaster, or the Velocicoaster, whatever it is called at Universal Studios, is a beast. That thing is just a monster of a roller coaster. If you haven't been on it, you should go. It's
so sad.
Unbelievable.
Okay, so
man. Oh, God. That thing was so crazy. Okay, sorry. Back to stocks.
Okay, so I'm going to flip our outline a little bit, because I want to explain first what is a stock market index. And then we've got like a fun little game that we're going to play. And then we're going to go back to getting serious with it. So a stock market index measures the performance of a certain portion or subset of the overall market. Okay, so we're going to take a grouping and we're going to measure it based on the size, the performance, the influence, and really just try and kind of categorize. And market indexes have many uses and can come in many forms. So these indexes for assets from different parts of the world, from different industries, and so on. You'll think about it, it's like, okay, here's, you know, a tech sector index, or here's like the top performing index. And each of these indexes are going to have a description on what is this category. So this could, you know, technically, I guess, Court could make his own little index. Here's Court's favorites stocks index.
So an index is just a snapshot of performance. Is that what I'm hearing?
An index is a list of stocks or securities that are measured on a daily basis, basically, to demonstrate performance of a particular type of stock or security market. So, for instance, the S&P 500, The Standard & Poor's 500 is a list of 500 companies that have made it onto that particular list that are measured on a daily basis, how their performance did on a daily basis. There is a calculation that goes into the actual end number of the S&P 500, like what the number is that you give that is the S&P 500 number. There's a calculation that they use to combine the performance of all of those stocks, all of those 500 companies together into one number that is then given, and it's a demonstration of how those 500 companies combined performed on a particular day. So it is a snapshot of a particular day, at least when it closes, when the market closes at the end of the day. You know, okay, this is where it closed at the end of the day. You could watch it all over the course of the day and see it go up and down, but it's supposed to give you an idea of how the stock market generally is performing. Now, they have, like Katie said, there are other indexes. So there's...
Well, that 500 can change. So it's like just because,
it's not set in stone.
Your stock got on the S&P 500 today doesn't mean it's going to be on it next week. And so it's really...
It doesn't change that frequently.
But yes, like that's an exaggeration. But it does change where it's really trying to be a representation of the overall market.
Gotcha.
But then there's others that it could be like, I really want to... Indexes and exchange traded funds, those are kind of a little bit hand in hand for a very, do not come at me, y'all, a very generalized opinion. Because, for instance, you can have an exchange traded fund that follows the banking sector. And so it's a mix of some of the top banking stocks to really give you that exposure of all these different stocks. Index, a lot of times people will compare. How is my current portfolio doing compared to the S&P 500?
This is just supposed to be a general description of what the stock market index is. We're actually going to get into the details, a little bit later on, because the game, I guess, makes more sense if we have a basic idea of what an index is.
That's what I was thinking. So, okay, this is going to be the BullCast Power Ranking game. So since, as we said, stock indexes rank companies based on size, performance, and influence, today, each of us are going to do our own ranking game. Nicole has picked a non-fictional category, and you'll be ranking your top 5 in that category. You must defend your picks, just like the companies fight to stay at the top spots of the S&P 500. So this is going to be the B&C 500. Your category is top 5 fast food menu items. Go.
I'll go first, because when you say fast food to me, the number one fast food menu item must be French fries. There are times when I decide not to go to a restaurant because even though I might like their sandwiches, if they don't have fries, I'm like, no, it's not a fry joint. I want fries. I don't know why any restaurant doesn't. Even Taco Bell has now added French fries to their menu. So I'm all for fries. I think fries has got to be a top menu item no matter where you go.
Are we doing broad or specific items? I need to know. Like you did fries, but you didn't say.
But it's like are we doing like
fries?
Yeah.
So somebody give me some rules.
I think in terms of top fast food menu items, I was thinking more just like items that you find on a fast food menu.
Okay, so we'll go broad here.
Broad, okay.
I'll say burger. A burger has to come after fries. It's easy to eat in the car, fairly affordable.
Yeah.
They come in all shapes and size. Well, not shapes, but sizes, you know.
I mean, throw chicken tenders in there.
Well, I mean, yeah, especially for me, I gotta have chicken on the menu.
Chicken tenders, chicken nuggets, one of those. And that's really, that could be 1 or 2 items right there.
Yeah, so we've got fries, burgers, chicken.
Healthy option. You know, a lot of people find that important.
Trust healthy from fast food.
I don't know.
I guess if you want, like, we could take those categories. Those are our categories. And within them, we could say, for instance,
the top 5 fries, the top 5.
So fries, burgers, and chicken strip/nuggets.
Yeah. What are the places that deserve to be in our index?
Yeah. And so let's take fries, for example. We're getting real, we're going out there now.
Yeah.
Obviously, if you're comparing fries, like somewhere like a McDonald's is globally known with their French fries.
Yeah.
Versus if we were to compare, Freddy's is not as well known.
Shoestring.
I have not ever had Freddy's. I don't think they serve chicken there, so I've never tried it. Oh, do they? Do they have chicken?
I think they have chicken. Yeah, I think they've got tenders. But that is us trying to explain to you the difference of size. A McDonald's compared to to a Freddy's.
Right.
I mean, even a McDonald's compared to a Sonic. Like, Sonic is huge, but Sonic is huge in our region, really.
Yeah. I think basically what you're saying is if we're going for the top 5 have to be in our index French fries, McDonald's is in there.
It's probably top of the list.
McDonald's is probably the
It's
top.
not my favorite, but like you said, it's well known and a lot of people love McDonald's fries.
Yeah. Performance of their fries.
Not their ice cream machine.
Definitely would be determinative of the fry index that we're putting together.
I don't know if this is a hot take, but also under fries, I would have to put Five Guys.
Oh,
They
yeah.
taste very good, but there's also quantity.
Yes.
You know, they do a few extra scoops into your bag. That's what they're known for. That's why they charge a premium. It's very expensive to eat there.
Yes.
But it's amazing.
Yeah, the fries at Five Guys are definitely on my
The
list.
Cajun ones are the best.
I used to love Backyard Burger fries.
Oh,
Again,
me too. So good.
Yeah,
but Backyard Burger is...
It's defunct.
It's defunct. It's, yeah. They had a really good burger and really good fries. The seasoned fries, not the waffle.
Definitely the seasoned fries. In my childhood, I preferred Wendy's fries over McDonald's, but Wendy's went into this whole thing where they were trying to come up with a better fry, and they changed their whole fry recipe.
Yeah.
And I don't think they're as good anymore as they used to be. I can't remember the last time I ate
And
it.
everybody's upset about Chick-fil-A that they've changed their fry recipe.
I hadn't noticed.
I didn't notice a big difference, but people are upset. And that
Really?
brings up a good point because I was thinking of the next fry, and it could be a toss-up between Arby's curly fries and Chick-fil-A waffle because they're different. What sets them apart? I
And
eat
that's a personal
Chick-fil-A
opinion.
way more than Arby's. I rarely eat Arby's.
I eat Chick-fil-A's waffle fries like they're going out of business.
So should we put both of those fries on the list or just Chick-fil-A?
Yeah,
I think
no,
so.
100%.
So we've got McDonald's, Five Guys, Arby's, and Chick-fil-A.
Right.
We need a fifth.
We got a spot for one more. Who's got that power suggestion? Why do you want it on the list?
You've got, I'm just naming some fast food. You have Burger King. People love their fries. You've got Popeyes and KFC, who both have fries.
Right.
Yeah.
You've got places like Zaxby's and I think
Zaxby's and
Zaxby's is
Guthrie's.
crinkle.
And,
they have the crinkle fries. Yeah. You can get seasoning on them.
Yeah.
Ooh, and their sauce.
Oh, I'm drooling now, guys.
You want to do Zaxby's crinkles?
See, and that's like, I have one that's a little lesser known, David's Burgers.
Oh, it's so good.
David's Burgers
Never
fries.
ending fries.
Yeah, they're never ending. Like, if you are in the restaurant, they just keep walking around with French fries, kind of like Lambert's, so it's great. But see, that's a lesser known one.
That's true. So
Doesn't
this is
matter.
like-
We're arguing here for what should be included. So,
So, I mean, that's where it's like our category here, like our index, like if obviously we had 500, then that's going to have the representation of a David's Burger and a McDonald's.
right.
But if we're just looking at the gross number of fries sold, it'll probably have to have like a Wendy's or things like that thrown in there.
Yeah. Sorry, guys. Crystal was just knocking on the door, and I told them to go away.
Go away.
Yeah, I said no.
Maybe we'll replace Zaxby's or whatever with Wendy's just because it is mass-produced, kind of like a McDonald's.
Yeah. Again, they're competing with Wendy's is competing with McDonald's and Burger King. They were the big three when I was a kid again. And I preferred Wendy's over McDonald's and Burger King, but Wendy's messed with their recipe. Although, it's also well known that McDonald's messed with their recipe. It used to be a lot simpler the way they made their fries than what they do now.
Right.
Everybody has a lot to get on like a health soapbox, but everybody has a lot more preservatives and flavor additives and stuff like that in their stuff than they used
Well, and it all depends on like how hot and fresh are these fries.
Yeah. Well, and I also will point out that we specifically used fast food as one of the things that get you on the list.
Yeah.
It has to be fast food. But my favorite fries are Huey's fries. I love Huey's fries.
Steak fries.
Man, those thick cut fries, especially when they're cooked just right, those things are delicious.
Yep.
But they can't go on the list. So do we still need a number 5? Or
No, we have it.
No, we got it.
We can fly through the rest of the list, but fries, we've got McDonald's, Five Guys, Arby's curly fries, Chick-fil-A waffle fries, and Wendy's fries. When we move to burgers, I think y'all could agree the top 3 would be repeats, McDonald's, Five Guys, and Wendy's, right?
Yeah.
Like, are we in agreement with that? So we need 2 spots to fill.
Well, with burgers, you got a place like In-N-Out, which is not massive around here, but which
It is massive on the West Coast.
Yeah.
Then there's another.
I mean, do we have to put Burger King? I mean, Burger King's
King.
not my place, but
But it is another huge joint.
it's a burger
And it
place.
has burger in the name.
See, like Backyard Burger would have been on there.
I would
but
have argued hard for that, but they went bankrupt.
Yeah,
so.
it's so sad.
We could say In-N-Out Sonic or something. I don't know.
I think a lot of In-N-Out fans would probably take issue with you trying
You're
to...
comparing.
Okay, to appease our Californian friends, we will say McDonald's, Five Guys, Wendy's, In-N-Out, and Burger King.
Okay.
That works.
Yeah.
Now, this next one is your list. It is chicken nuggets / strips.
Listen now.
Oh, see, and there's arguments out there about that with the
Chick-fil-A. I mean, Chick-fil-A's got to go on there. I'm ignoring any sort of political objections to any restaurants.
Raising Cane.
I've never had Raising Cane, but
It's so good.
Oh, it's so
there
good.
is not a Raising Cane in this town, in this city, and I've never had it in any of the other places.
It's like a more fun, spicy Zaxby's.
It's Raising Cane, Guthrie's, and Zaxby's.
I love
a lot
Zaxby's.
of times get compared.
And if I have to choose between Zaxby's, Guthrie's, and Slim Chicken, I'm going Zaxby's all the way. I don't understand why Guthrie's exists as a restaurant. All they have is strips. That's basically it. I don't know how they survive. When you
That's
don't have
how
any
Raising
other,
Cane's is.
They don't have any other menu options. Give me a sandwich.
Raising Cane is the same way.
Give me some wings. Give me a sandwich. Give me something, guys. I mean,
But they make a profit. It's overhead. You think about it. You know, how many tenders do you want? How many fries? Do you want some slaw? What are your sauces?
Yeah.
Boom.
So
Done.
you've got Chick-fil-A, Raising Cane's, and Zaxby's. That's what I'm putting for the 3. Now, fill your other 2 spots. Do you want Slim Chickens? Do you want Popeyes, KFC?
I think we got to put a traditional
That'll make the New Orleans fans happy.
bucket of chicken on there, which is going to be either Popeyes or Church's or Kentucky Fried or something like that. And I think I would definitely go with Popeyes.
Yeah, the crunch is better.
Yeah.
Okay. And wrap up the list with one more.
Just because, again, size and significance of market impact. I was going to say McDonald's. So
Yeah. They're
McDonald's or
nuggets.
I didn't think
KFC.
about
Because McDonald's chicken nuggets are like
Yeah,
every child in the world probably has eaten those chicken nuggets. So
Are
if
they
we're-
chicken? Not sure, but they're
Yeah,
people
but
love them.
they call them chicken. So
Do they still have their strips? They used to have really good chicken strips.
they used to have strips. They took them off the menu during COVID-19 and they never put them back. But you know what else they took off the menu during COVID-19? They took breakfast bagels off the menu during COVID-19 and them babies is back. And my family rejoiced. So maybe the strips will come back. I don't know, but they're still gone
I promise
for now.
this episode has a point.
So
Anyway.
we have McDonald's. There it is.
Yep.
Chick-fil-A, Raising Cane's, Zaxby's, Popeyes, McDonald's.
Yeah.
KFC.
Sorry, we probably shouldn't play these games when Court's hungry.
Yes.
Okay, so we have our own power ranking. Investors in economics track the biggest and best companies with stock market indexes, but how do these rankings work in finance? So we're going to break it down. Obviously, this was our opinions, but as you heard, as we're talking about this, trying to create an index, we were having to remove personal opinion and really think about what are the bigger companies. Like, while we may not particularly crave the McDonald's chicken, you still can't beat the fact that that is going to be, it has the most locations. When you're on road trips, like, you more than likely can, if you need a chicken option, you can find a McDonald's more than likely.
Well, think of it like a survey almost. It's not exactly the same, but the idea of a survey is you find a sample of people and ask your entire sample the same questions over and over again. Then the responses to their questions are supposed to reflect a larger portion of the population than the sample that you chose. So a lot of these indexes or indices are specifically chosen to try and reflect a larger population of securities than just the securities that are on the index. So that's what they're going for here. Again, they are going for a reflective, this is how this particular area is doing. And so we'll start with the big ones. Dow Jones Industrial Average, I mentioned that earlier. It was founded in 1896 by Charles Dow and Edward Jones. The Dow is a price-weighted average. That means that stocks with higher price per share levels influence the index more than those with lower prices. So initially, it included 12 industrial companies, hence the industrial average, such as producers of gas, sugar, tobacco, oil, and railroad operators. It's gone through a lot of changes since then. So now it also includes technology, healthcare, finance, and consumer companies. General Electric, for instance, blue chip stock, I guess, was one of the original Dow members. So now the Dow, instead of 12 as it was originally, it's now made up of 30 large U.S.-based.
Yep. Okay, so there's the parameters. Large and U.S. based.
Yeah, stocks. It was designed as a proxy for the overall economy. So like I said, they're not looking for a specific subset. They are looking to reflect the performance of the overall economy.
So that's why a lot of times, and we're going to talk about it a little bit more, you'll hear people comparing to the Dow. And like Court started off, the news would say, here's how the Dow ended, because it kind of gave an overall economic perspective of how the overall economy was doing.
Yeah, interestingly enough, I think
average, you would say.
If my memory is correct, when they used to tell us what the Dow closed at back when I was a kid, it was like 5,000. Like I remember the day that the Dow broke 5,000 and everybody was like, it's above 5,000 for the first time ever. And now, of course, it's way higher than that. The next one, Katie, you want to take it?
Yeah, so the S&P 500. Again, this in the Dow is something that a lot of people go, oh, I want to try and beat the S&P 500. I want to try and beat these things. Okay. The S&P 500 index was created in 1923 by Henry Barnum, Poor's Company, Poor's Publishing. It began by tracking 90 stocks in 1926. Standard & Poor's was founded in 1941 when the company merged with Standard Statistics. Today, the S&P 500 is a market cap weighted index. We already talked about that, meaning the companies whose market value is larger have a bigger influence. Okay, so that's kind of what we talked about McDonald's. McDonald's has a bigger influence than an In-N-Out. Mm-hmm. Don't come for me, California. It tracks 500. Okay, so the Dow was 30. This tracks 500. Mm-hmm. Makes sense. S&P 500. Mm-hmm. 500 of the largest U.S. companies, giving a broader view of the market than the Dow. It's the benchmark index for most investors. Mm-hmm. Benchmark index. Okay, so you think about it. That's kind of where you're going to always compare yourself. So some people may want to be more aggressive than the overall market. So they compare to the S&P 500. How are they tracking on that? Lose less than the S&P 500, gain more than the S&P 500. So it's constantly, they're comparing themselves to this S&P 500 index. That's their benchmark. You want to take the last one?
Yeah, absolutely. We touched on this briefly yesterday. The NASDAQ composite. This was the first electronic stock exchange. So like new age, which is kind of cool.
Do you remember what those letters stand for?
Is it national?
Katie
came in clutch yesterday. Hang on, let's look it up. The National Association of Securities Dealers Automatic Quotation System. Mm-hmm. All the words just jammed together.
You're ready for Jeopardy.
Ready for Jeopardy. This is interesting. The NASDAQ is heavily weighted toward tech stocks like Apple, Microsoft, and Tesla, which we talked about a couple weeks ago.
Mm-hmm. My very rudimentary understanding of markets back 25 years ago, it was the tech market. To me, as a person outside the industry at the time, it was the market.
Okay, so why do stock indexes matter? Investors use them to track performance. Absolutely. I mean, people, when you're investing, whether you're savvy, you're doing it yourself, you're day trading, whether you're working with an investor, you always have that kind of pit in your stomach where you want to be like, how am I doing compared to others? Because at the end of the day, we've talked about it till we're blue in our face. We do all compare ourselves to others. It's just part of our DNA. We are constantly trying to compare.
Keeping up with the Joneses.
Exactly.
Yep.
How are we doing? Are we more aggressive than most people? Are we less aggressive? Mm-hmm. You know, are we getting the same return? And especially this day and age where you hear the rumor mill and you hear, well, my friend was making 10%, or my friend made $10,000 versus, lost $10,000. Okay. Again, there's so much that goes into that of how much do you have invested? How do you have your allocations? Things like that. So a way that anybody can compare is by looking at these indexes. They can really look at it because this is made up. These are 3 different structures that show the different economic impact and shows, okay, the Dow with the 30, S&P 500 with 500 of them. And then you got the NASDAQ that's more heavily weighted with the tech stocks. So you can compare your personal portfolio to these different indexes. And fund managers use them to compare their results. So when they're braggadocious, that's not the right word, when they're trying to pitch to people about why somebody should invest in their fund, they're going to say, our performance over the past 5 years has been X compared to the Dow, the S&P 500, because they want to give you perspective. Well, while the S&P 500 was down 2%, we were up 5%.
Right. It's an interesting side note. We do have clients that will come to us and say, and I think we've probably discussed this before broadly, and we're going to discuss it very broadly right now. Again, it's one of those topics that we could probably make a whole episode out of. And maybe we have. I don't know. Everything is blurred together now. A lot of times clients will come to us and say, why is my portfolio not performing as well as the market, or as well as the S&P, or as well as the Dow, whatever it is that they are comparing their portfolio to? And a lot of times the reason will be, look, we can show you how risky the stocks are that make up the S&P 500 and what the risk level of the S&P 500 is, and putting your money in those stocks, what your chances are of losing that money versus gaining more and so forth. When we determine what your ability to tolerate risk was and what your ability was to put up with the possibility that you might lose money, we determined that you are more risk averse than the amount that would allow you to actually be invested the way in the stocks that this particular index is made up of. So you can't just look at your portfolio and go, oh, I'm not doing as well as the market. That means it's bad, because you may be invested in a way that you are comfortable with that allows for the level of risk that you are willing to take, or your goals may be different. You may not be looking at wanting to grow. Maybe you need income, and so you're invested in a way that is going to provide you with income, and that changes how everything is going to look to you. But that doesn't mean that these indexes are bad benchmarks. It just means you have to look at it from the perspective of, why are you invested the way you are versus what makes up that index.
Right.
You're correct. There's always so much more to it. And that's why investing is emotional. There is a lot of components to it, but you got to make sure, are you comparing apples to apples? Are you comparing apples to oranges? Mm-hmm. You can't even compare the performance that Cam gets in his portfolio compared to me, because we're going to have different objectives. This is why this is created. Index funds, ETFs, I talked about this at the beginning, exchange-traded funds and mutual funds, they provide easy diversification. Mm-hmm. So those are going to set certain objectives. They're going to be public about it, of this is going to be an exchange-traded fund or a mutual fund that follows the growth sector, or this is going to follow the tech sector, like I talked about the regional banking exchange-traded funds. Or it could be one that mirrors the Magnificent Seven. I mean, there's so many different things, and that's why picking index funds, picking exchange-traded funds, mutual funds, things like that, you are not owning Tesla and Apple and Microsoft. You do not have ownership in any of those companies, but you are owning an index that is tracking that. Mm-hmm. So at any given point, it could change where you're 25% weighted in Apple. The next day, you're going to be 20% weighted in Apple. It's going to change. It's going to evolve because you are investing with a manager, a fund manager who's going to be making those decisions. So that's why I say diversification, because it's acting as the Dow or the S&P 500 or whatever you've tracked. It's giving you that broad exposure without some of the risk of you are then having to choose, do I buy out of this? Do I sell out of that? Like, it's taking away that and putting it in the hands of someone else, which is why, going back, those fund managers, those ETF managers, they're trying to sell you on how they compare to the different indexes.
Yeah.
So index funds are popular due to lower fees, broad exposure, and long-term growth. Mm-hmm. Okay, so now that we know how to measure the stock market, let's talk about how it moves. Markets go up, markets go down, markets stay the same. But why? Why do they do that? Can we predict what happens next? No, we are not fortune tellers. We often tell clients all the time, we do not have a crystal ball. The only thing we can guarantee is the markets will go up, will go down, or stay the same. Mm-hmm. That's all we can guarantee is we don't know. That's again why, did you hear me say when we talk about these performance sheets, these different papers that you will read that tell you how a fund has performed? It talks about historical data. It cannot talk about future predictions because we cannot predict the future. We cannot promise that this is what it's going to do. You can just look at what it's done in the past. So in our next episode, we're going to break down the 4 phases of the stock market cycle. What drives bull and bear market? Okay, remember, bull up, bear down. That's how I remember studying it.
And remember, we are called BullCast. That's where we get our name.
And how history has shown us what goes up and what often comes down.
What goes up? Who sings that song?
Must come down. Spinning wheel. That is blood, sweat, and tears, my friend.
Okay.
Yes, sir.
Okay, so any other final thoughts about indexes? Cam, you started this off and was talking about Velocicoaster. So do you feel like you've got a better understanding about index funds now? now.
I do. It's all about like benchmarking and measuring, and it's very important for people to look back and compare it to other things. That's very important in the stock market.
Yeah. It's very important in life is constantly, what do you measure yourself off of, and give yourself some grace to compare to. And it's like, you can't expect in your 30s to be the CEO, like compare to something that's, I don't know.
Have you met a 30-year-old these days?
They all think they can. But you should always compare, whether it's you're on a weight loss journey, you're on a education journey, a business journey, a stock market journey. Make sure you're comparing yourself to something that makes sense. And so hopefully this gave you a very broad understanding. This is my bullseye. Here we go. A very broad understanding of what the indexes are, what they're made up of. And so now when you Google a stock or you Google an index fund, you kind of see that S&P 500, or you hear on the news, this is what the Dow closed. You have an understanding of what ends up making these indexes, what are a part of it.
And there's the closing bell. Ladies and gentlemen, you've made it to the end of yet another episode of the BullCast podcast. If you liked what you heard and you'd like to hear more, please feel free to go to your favorite subscription service and sign up to have our BullCast beamed directly to your device every single Thursday at noon. If you'd like to find out more about Cameron, Katie, Cortland, or Nicole, please feel free to go to our website. That website is bullcastpodcast.com. We've got bios up there, we've got pictures, and we've got a place where you can drop a comment or suggest a topic you'd like to hear us talk more about. But hey, I mentioned pictures. We do have pictures on Instagram. We've got an Instagram handle, and that handle is at BullCast Podcast. We also have an X handle, which is at BullCast Podcast. And we have a Facebook page, which is BullCast The Podcast. So you can check us out at any of those places. But we do tend to mention the fact that we work at a place called Pickler Wealth Advisors. And if you would like to find out more about us, find out about our team, find out about what we do, find out about what we can do for you, and of course, find out about our boss, David Pickler, then please feel free to go to that website. That website is picklerwealthadvisors.com.
That's advisors with an O.
Not an E.
Ladies and gentlemen, we haven't quite given you everything you need yet. We've got one more episode to go. We're going to be breaking down the 4 phases of the stock market cycle in the next episode. So come back next week and hear more. But for now, I'm Court.
I'm Katie.
I'm Cam.
And we're done.